Hello, econ classes. This is going to be a brief lesson on banking, the Federal Reserve, and monetary policy. We've already learned about the Federal Reserve, so the first emphasis of this lesson is going to be on banking. The second part is going to be on monetary policy. So just to review really fast, why do we have the Federal Reserve, the central bank in the United States? I've listed 5 reasons here. And the last one is the most important, which you can tell because it's in bold. But before we get there, let's just list the others. 1, they issue our currency. So every paper dollar has Federal Reserve note on it, and you can see which district it's come from by analyzing the bill. Number 2, they clear checks, and it's a central storing house for that. We don't actually clear any checks in Minneapolis anymore. All of our checks go to Cleveland, and you can guess why. The number of checks written has steadily declined over the years as electronic commerce has picked up. The Federal Reserve is the fiscal agent of the federal government, and that means that they are the place that the federal government keeps their checking accounts. That's where they keep their money. That's where they clear all of their expenses. And another major function, this would probably be the second most important, is that they ensure and supervise and stabilize the entire banking and payment system. Every time that you're making exchanges, and all the different bank activities are overseen by the Federal Reserve. Even though that is essential to our nation's money supply, the biggest function is that they can change the amount of money that's out there, and that is called monetary policy. You can even highlight that, monetary policy. And that's what we're going to do next. Before we can do that, though, we have to discuss in general what a bank is. I'll take you back to our lesson the other day when we talked about the definitions of money. You have M1, M2, and M3. Well, M1 is M1 is essential to the definition of a bank. Any institution whose holdings are part of M1 would be considered a bank. And there are some clear reasons that we use banks. You don't have to look too far to find people that don't trust the banking system. They may be people who lost money in the Great Depression. Every year there's somebody whose grandparents had that happen. But essentially having banks takes away a lot of the cost that we would bear in trying to find people to lend money to when we have extra, or going to find people to borrow from when we don't have enough. And that's that first point there, that having banks minimizes the cost of borrowing and monitoring loans and finding loans. There's loss of risk and added security by leaving our money in banks. And the last part is liquidity creation. So this next part, I'm going to introduce you guys to something called T accounting. T accounting, as you're going to quickly see, looks like this. And over here you put assets. And over here you put liabilities. I'm going to just abbreviate that. That's liabilities. And to be very, very general here, a liability is something you owe. That didn't make it on the screen, did it? O-W-E. Whereas an asset is something you own. O-W-N. Okay, an asset is something you own, a liability is something you owe. Now let's do a simple example where I go and deposit $100 into the bank. And that is now a liability of the bank to me. They owe me that money. If I wanted to withdraw it, they would have to give it to me. But that $100 is also now an asset. And I'm going to split the asset up into 2 different parts. $10, using the definitions above, is going to be what economists call the required reserve. And we have what's called a fractional reserve banking system. That's up here. Because there's a portion of the M1 that I deposited that they are not allowed to loan out by fiat of the Federal Reserve. And that part that they can't loan out is called their required reserve. In this instance, you can see that the reserve rate is 10%. They had to keep $10 on hand right here when I deposited $100 in the bank. They had to keep 10% of it, but the balance of it, the $90, is the excess reserve. And they can loan that out to the next person that comes in with a need for money for a business idea or a car or a house or whatever it is. So banks create money, and I'll emphasize this up here at the top. We can circle this. Banks create money, and this is a distinction to make between a bank and a mint. A mint prints money or stamps money. A bank actually creates it because every time they make a loan with excess reserves, money is created. Let's highlight that there. Every time a loan is made, money is created. Okay. Didn't mean to do that. That's okay. If we look at the actual reserve requirements from the Federal Reserve, you can see that on more than 44 million, they do require banks to keep 10%. Here are the effective dates. This all is rarely changed. Very rarely do they update the reserve requirements. But this is an easy way for you to see that they can manipulate the money supply. I'm going to show you how on the next slide. Let's imagine a new scenario where you guys can now look and see the reserve rate has changed to 20%. Okay, the reserve rate is 20%, which means let's say I go and deposit $100 in bank A. They now have to keep $20, and their excess reserves, the difference between the deposit and then what they have to keep, what they can lend out, is 80. And when they lend out the 80, you can see over here in this column, that is new money created. So that $80 is now freed up to do work in the economy. Let's say my friend Eric comes in, he needs to borrow $80 toward a new car, and they can pool together my excess reserves with everybody else and lend Eric the money. Well, Eric gets a loan in order to go spend it on something. Nobody gets a loan in order for it to just sit in their bank account. So he goes out and he spends it on what he needed it for, and that money gets redeposited in Bank B after it's spent. Bank B has to keep 20% of 80, which is $16, meaning they can loan out 64. And when the 64 gets created, the money supply has gone up. Now, some of you probably can see this really easily. The money multiplier is 1 over the reserve rate. Now, I'm going to talk about that more on the next slide, but if you do 1 over 0.2, 1 over 0.2 equals 5. Why am I talking about this right now? My initial deposit of $100 can turn into $500 in the economy. Or my excess reserves of 80, 80 times 5 is $400. So those $80 in excess reserves, through spending and redepositing and spending and lending and redepositing over and over and over and over, you can see the process goes on all the way down through these other banks. It results in $400 of new money. And that's what economists call the money multiplier. Now, the reason this is important is that this is the first tool of monetary policy. And you can imagine if there's a recession and the reserve rate is 20%, the multiplier is 5. So my $100 deposit could turn into $500 in the economy. And what I mean by that, if you go back here, my initial deposit is still M1. That's a pretty bad M, but it's still M1. And this $400 is also M1. And 400 and 100 is 500. So with a 0.2 or a 20% multiplier, or 20% reserve rate, the multiplier is 5. But let's say the Fed is worried about a recession, so they lower the reserve rate to 10%. What just happened to the multiplier? It doubled. My $100 could now turn into 1,000. Now let's assume that they're worried about inflation. What is the Fed going to do if they're worried about inflation? They raise it to 50%. For every dollar that gets deposited, 50 cents stays in the bank. The multiplier is now 2. and my $100 could only turn in to $200 total by the end of the whole process. So you can see that the reserve rate is a powerful tool of monetary policy, but there are some problems. One, what if borrowers don't spend all the money? That doesn't make any sense, because if you borrow money, you're paying interest on it, but it could happen. This is more likely. What if banks don't lend their excess reserves? And this is what happened during the recent recession. Banks were so fearful of one another and losing their capital that they sat on excess reserves. They simply didn't lend them. And another problem is if people get fearful and they hold on to cash, the whole system is not going to work. Here's one more picture of this. You can see a $100 deposit of new reserves. That initial deposit still counts at the end as $100. The multiplier here is clearly still 5. 5 times 80 is 400. 5 times 20 is 100. You have a total of $500 of M1 at the end of the whole process. So that's the first tool of monetary policy. Raise or lower the reserve rate. Check. They rarely do that, but they could. Number 2, raise or lower the discount rate. We'll do that. The discount rate is when you borrow from the Fed. The federal funds rate is when you borrow in between banks, and the prime interest rate is extended by banks to their best customers. Now, all these rates are interest rates, which is the rental rate of money. How much does it cost to borrow it? Here's a diagram I use to describe all three. This is really important here. This bank up here is the Fed. Okay? The Fed is the lender of last resort. And they are going to influence the federal funds rate to be lower than the discount rate so that banks can lend to one another. So you could say, this bank here, let's call them Wells Fargo, and over here is U.S. Bank. The Federal Reserve wants U.S. Bank and Wells Fargo to lend to one another at the federal funds rate if they need any excess, or they aren't meeting their required reserve at the end of the day. If they won't lend to each other, so let's just imagine no one's lending to each other at the federal funds rate, well then you could turn to the discount rate and borrow from the Fed. And it also gets called the discount window. Okay? But primarily banks lend to each other, and we, if you again imagine me, here's my friend Eric. I should probably switch these to be kind. Let's switch it. Eric has great credit, and he can borrow at the prime interest rate. And when you see subprime interest rate, this would be me going into the bank and getting a bad rate of interest. It would mean I'm not credit worthy, I have trouble paying things back, and they're taking a higher risk in lending to me. So subprime refers to the lender, and not actually to the loan. It's saying that I am less than prime. Okay, so this is a picture of all the rates. You can clearly see that if the Federal Reserve is worried about inflation, what are they going to do to that discount rate? Raise it. Make it really hard to borrow money from them. If they're worried about recession, lower it, right? And they're going to push the federal funds rate down. The last piece, I'm sorry, this is now over 13 minutes, but the last piece. How do they influence this federal funds rate? Because this is something they influence every single day through open market operations. And we'll spend time practicing this in class, but you can see right here in the middle of the screen is the Federal Reserve. And on the left, the Federal Reserve is going to increase the money supply when they are worried about a recession. Okay, and the way that they increase the money supply is they are going to buy securities, and a security is an IOU, like a government bond. You lent money to the government, they took the money and spent it on something like Social Security or a submarine, and then they pay you back in the future with interest. So that's what a government bond is. It's an IOU. Well, banks, they have options with their excess reserves, right? Remember those? Their excess reserves, they could lend to you to buy a house or a car, or if the interest rate is better from the government, they'll lend it to the government, in which case those excess reserves turn into IOUs. Well, what if the Federal Reserve wants more cash in the economy? They can buy all of those IOUs with money that they print, and all that money goes into the vault. Here it is. And then they lend it out as excess reserves go up to have money at work in the economy. Can you see that? Now this over here on the yellow is if there's a recession. But what if the Fed is worried about inflation? Let's look at the blue side. Over here, they are now going to sell all of the IOUs that they have, all of the bonds, and when they give them to banks, the banks' excess reserves dwindle. They have no cash because now they have a bunch of government securities, and they're paying money to the Fed when they are sold the securities. So the Fed can change the prices they'll take. They give a good deal. The banks buy securities. They give their money to the Fed. The money supply goes down, and there's very little money at work in the economy. And again, you do that when there's inflation. So the summary slide, and this is it. Expansionary monetary policy, also called easy money policy, is during a recession, right? So the problem is unemployment is high. So there's a recession, and you are going to want a really low interest rate. The way you lower the interest rate, you have a low reserve rate, a low discount rate, and you buy bonds. This stands for open market operations. Over here, the contractionary monetary policy, tight money policy, as it's also called, is when there's inflation. And when there's inflation, they want to fight the rising prices through raising the reserve rate, raising the discount rate, and selling bonds through open market operations. We'll watch a video on bonds in class, very short video, it's like Schoolhouse Rock, and we'll practice this all next class. Thank you.